Did you know the S&P 500 doubles every 7 years? A striking thought, isn't it? Now, what exactly is this S&P 500 we're talking about? Well, friends, the S&P 500, or the Standard & Poor's 500, is a stock market index that captures the pulse of the US economy. It takes into account the stock performance of 500 of the largest companies listed on the stock exchanges in the United States. It's like a mirror that reflects the financial health of these corporate giants. From tech behemoths like Apple and Microsoft to financial stalwarts like JP Morgan Chase, and from healthcare leaders like Johnson and Johnson to consumer goods giants like Procter and Gamble, the S&P 500 encompasses a broad range of industries. It's a melting pot of American commerce, if you will. Now, why is the S&P 500 so important, you ask? Well, it's considered one of the most reliable barometers of the US stock market. When you hear news anchors on financial networks say, the market is up or the market is down, they're often referring to the movement of the S&P 500. It's that influential. The S&P 500 isn't just a measure of stock performance, it's a snapshot of America's economic prowess. It's a testament to the strength and resilience of the US economy. And it's not just for market pundits or financial whizzes. Whether you're an investor looking to grow your wealth, a business owner gauging the economic climate, or simply a curious mind seeking to understand the world of finance, the S&P 500 is a valuable tool. So, the next time you come across news about the S&P 500, remember, it's not just a number. It's a narrative of economic progress, of corporate triumphs and tribulations, and of the tireless spirit of American enterprise. Now let's dive into the historical performance of the S&P 500. After all, the past often holds clues to the future, and in the world of finance, those clues can translate into dollars and cents. Stay tuned. The S&P 500 has a fascinating history of growth. That's right, the Standard & Poor's 500, or S&P 500, has been a beacon of steady growth since its inception in 1957. It's a broad market index, taking into consideration the 500 largest publicly traded companies in the United States. Over the decades, the S&P 500 has displayed a remarkable ability to bounce back from market downturns, making it a resilient investment choice. To illustrate, let's take a stroll down memory lane. The late 1980s brought the infamous Black Monday, a day when the market dropped more than 20%. Yet within 2 years, the S&P 500 had recovered and continued its upward trajectory. Fast forward to the early 2000s. The dot-com bubble burst, causing a sharp fall in the market, but yet again, the S&P 500 stood its ground, recovering in the years that followed. And who can forget the Great Recession of 2008? The economy was in tatters and the market crashed. But like a phoenix, the S&P 500 rose from the ashes, regaining its losses by 2013 and continuing to climb. This resilience is not just happenstance. It's largely due to the diversified nature of the S&P 500. With 500 of the largest US companies in its portfolio, the index spreads its risks, ensuring that a downfall in one sector doesn't bring the entire index down. The S&P 500 has not just survived, it has thrived. Since its inception, it has demonstrated an average annual return of approximately 10% before inflation. This consistent performance has made it a preferred choice for long-term investors. Now you might be doing some quick math in your head and thinking, 10% a year doesn't double my investment every 7 years, and you'd be right. But remember, we're talking about an average. Some years may yield lower returns, while others may surprise you with much higher ones. So you might be wondering, how does the S&P 500 manage to double every 7 years? Well, stay tuned. The magic of compound interest awaits in the next scene. The secret to the S&P 500's consistent growth lies in the magic of compound interest. Now, you might be wondering, what is this so-called magic? Well, compound interest is the process by which interest is added to the original amount of an investment, and then all future interest is calculated on this new larger amount. It's like a snowball rolling down a hill, growing bigger and faster with each roll. Let's break it down a bit. Suppose you invest a sum of money into the S&P 500, let's say $1,000. Now, if the S&P 500 gives a return of approximately 10% per year, which is its historical average, your investment grows by $100 in the first year. But the magic starts in the second year. This time, your interest is calculated not just on your initial $1,000, but on the $1,100 you have at the start of the second year. So, the interest for the second year is $110, not just $100. This process continues year after year, with each year's interest being calculated on the total amount from the previous year. This is the magic of compound interest, and it's why your investment doesn't just grow in a straight line, but accelerates upwards in a beautiful curve. This compounding effect is a key reason why the S&P 500 has been able to double every 7 years on average. It's not just about the individual performance of the companies in the index, it's about the collective power of those companies compounded over time. So, we've seen how compound interest works, and how it contributes to the impressive growth of the S&P 500. It's no magic trick or illusion, but a simple mathematical principle that, when applied consistently over time, can lead to extraordinary results. But what does this mean for you as an investor? Investing in the S&P 500 can be a powerful tool for wealth creation. You may be wondering why. Well, let's dive into it. The S&P 500 is a diverse basket of 500 of the largest companies in the United States. This diversity is one of the key strengths of investing in the S&P 500. Instead of putting all your eggs in one basket, you're spreading your investment across multiple sectors and industries. This diversification can help to reduce the potential risk of your investment. Now, let's talk about consistent returns. Historically, the S&P 500 has delivered an average return of around 7 to 10% per year. Of course, this doesn't mean you'll see these returns every year. There will be ups and downs, but over the long term, the trend has generally been upward. But here's where it gets really exciting. Remember when we talked about the magic of compound interest in the previous scene? Well, that's where the S&P 500 shines as an investment. The power of compound interest means that the returns you earn on your investment can themselves earn returns. In other words, your money is making more money. Now imagine this effect over a long period of time, say for instance 3 decades. That 7 to 10% per year isn't just a simple addition to your initial investment, it's compounded. It's growth on growth. And that, my friends, can lead to a significant increase in wealth. But let's not forget, investing isn't just about the potential for high returns, it's also about patience and discipline. The S&P 500 isn't a get-rich-quick scheme. It's a long-term investment strategy. You need to be prepared to ride out the market's ups and downs and stick to your investment plan. However, like all investments, the S&P 500 also has its risks. It's important to remember this. No investment is risk-free, and the value of your investment can go down as well as up. But with careful planning and a long-term view, the S&P 500 can be a potent tool in your wealth creation arsenal. While the S&P 500 has a history of consistent growth, it's not without its risks. As we delve into the world of investing, it's crucial to remember that the stock market is not a guaranteed path to wealth. Yes, the S&P 500 has a long-standing track record of success, but it also has its share of downturns, crashes, and bear markets. These market fluctuations can lead to potential losses, especially for those who invest without a clear understanding of the risks involved. Think of it this way. Investing in the stock market is like sailing on the open sea. The journey can be smooth and rewarding, but there will be storms along the way. The key is to be prepared for these storms, to navigate them wisely, and to keep your eye on the horizon. One way to weather these financial tempests is through the strategy of long-term investing. The S&P 500, as we've discussed, tends to double every 7 years on average. But this is an average. There will be years of robust growth and years of decline. By investing for the long term, you're giving your investment the time it needs to grow, to recover from downturns, and to benefit from the magic of compound interest. Another tactic for mitigating risk is diversification. Instead of putting all your eggs in one basket, so to speak, spread your investments across different sectors, industries, and types of assets. This way, if one part of your portfolio takes a hit, the other parts can help balance it out. In essence, the S&P 500 is a tool, a vessel that can carry you towards your financial goals. But like any tool, it needs to be used properly and with care. Be mindful of the risks, be patient, and be diversified. In conclusion, the S&P 500 offers a potential for significant growth, doubling every 7 years on average. But, like all investments, it's important to understand the risks and invest wisely.